Hey everybody, this is Richard Roop, and this is one of the weekly frequently asked question webinars that we're doing for our JV partners. And today is session number 2 on the secrets of free and clear deal investing. So also on the line I got Coach Courtney. How you doing, Courtney?
I'm doing great today. How about yourself?
I'm doing great. We want to go ahead and knock out another one of the questions we get all the time about investing in free and clear properties. And if you're new, I recommend you get some more information on the model. And also I can refer you to the first webinar that we did where we covered, how do we make sure we get our profit on a deal if we sell a house early, because sometimes we're paying a premium to a seller because of long-term financing. It's like, how do we make sure we make a profit if we sold it early? So we did do that on session number 1. Session number 2, what we're going to do is we're going to cover another question that we get a lot, which is, what if I pay top dollar to a seller for great financing and the market goes down? Have you ever gotten that question, Courtney?
Yes, we get that question quite a bit, actually.
So I've gotten it a lot too, and I've answered it a lot one-on-one. So here we go. What I'm going to do, Courtney, I'm going to use a deal example. Okay, I'm going to give you some simple numbers, and I'm going to show you how we protect ourselves. Okay, and what you can do differently if you're concerned about your market going down. Now, I've been doing a lot of deal structuring, a lot of market research, a lot of deals across the nation. And recently, what I've noticed, Courtney, is when one way to research the value of a property is to Google the address, and a number of the real estate value websites come up, like Zillow and Trulio and different ones like that. And on Zillow, there's a price trend chart, and I always take a look at that chart, and I'm finding that more and more markets have actually bottomed out. And so I actually am not concerned about prices going down, but real estate is a local game, and so if you're in a market where you're concerned, if you think prices are going to go down, then I'll show you how to structure your offers. If it goes down and you weren't expecting it, I'll show you what happens. Okay. So there's things you can do to protect yourself, but I think most people should not be expecting their market to go down unless they have good evidence, and you don't want to be too conservative in your deal structuring and miss a deal. So let's go ahead and take a look at this. This is a single family home. It's free and clear, bread and butter house, and it's worth $250,000. I think this is in California. It's actually a low-end house, I guess, in California.
Right.
$250,000 house. And that's the after repaired value. So this house needs about $10,000 worth of fix-up. So that's what we're going to plan on doing, spending $10,000 to fix it up, and then it will be worth $250,000. Our exit on this house would be to put it on the market right away after it's fixed up and offer it for $259,500 with terms, flexible owner financing or rent-to-own terms. And you can usually get a little premium when you're offering terms. In fact, sellers all the time, Courtney, they try and get a premium without offering terms.
Yeah, no kidding.
Their house is worth $250,000 and they're trying to sell it for $270,000 or $280,000, right?
Yeah. So they all have the nicest house in the neighborhood. Right.
Right. So we've determined it's worth $250,000, and I'm pretty confident we can get $259,500. Now, if you weren't confident in that, you would use $249,500, and if you weren't confident in that, you could use $239,500. But in this case, in a normal case, this would be $259,500 is what we would put it on the market for. The market rent is $1,300, and that's so we expect to get that income. Now, my favorite exit is putting a buyer in the house and renting it to them until they close, and not even expecting them to close. Especially not relying on it.
Right.
But we give someone the exclusive right to buy the house for a number of years, and then we want to get a purchase deposit. My program is to get $5,000 down. But most people can't find a lot of people with 5% down. A $250,000 house, you can find someone with 10, 20, 30,000 to put down these days, but it's you can't rely on it. So I want 5%, and I'm going to get 5%, but it's probably going to be in a combination of some money down and some money each month. You know, so if I had a great buyer and they just wanted to give me an extra $360 a month for the next 3 years, that would build up to $13,000. But normally I'd get maybe $6,000 down and an extra $200 a month. That would be typical.
Okay.
Profit goals. When I put all the numbers into the Ultimate Profit Generator software, it crunches all the numbers and spits out all the offers for you. I put in there a minimum profit goal of $50,000 or $6,000 per year held. So if I offer a seller to, finance me and pay him top dollar, on a 9-year plan, I'm going to get 9 times 6,000. 9 times 6,000 is 54,000. And if I get a 15-year note or a 20-year note, I'll make even more money. But I'm going to get a minimum of 50,000 or 60,000 per year, whatever's greater. It'll calculate that for you.
Okay.
Now, another goal is to pull out some extra cash the day we buy. We always do that. And in this case, we're going to pull out an extra $10,000 in cash that we don't need for the deal, so we can put it into our pocket. We're also going to reimburse any money we spent prior to closing the deal. So if we spent money on an appraisal or if we spent some money sending out postcards, we're going to get reimbursed for that at closing as well. All right, some other inputs in the Ultimate Profit Generator that I used is we typically use 48 months of no appreciation. So we're already expecting the house not to appreciate for the next 4 years. That kind of protects us, right?
Absolutely, sure.
So we're already protecting ourselves against, changes in the market, and the house might start going up, in the next year or two, but we've already calculated no appreciation for 48 months. Then after that, the historic average for appreciation is about 4% a year on real estate, and we're only using 3% thereafter. I'm also planning on offering rent credit to my tenant buyer for the first 12 months of $200 a month, which is typical. And I also expect a tenant buyer to either close or disappear on me within 36 months. So it's
right.
When you put a buyer in the house, sometimes something happens. They don't close on the house. They leave the house. You put it back on the market, and you put someone else in there. And so
right, and those $200 rent credits you had counted on giving back to them, if they leave, you don't have to do that. So then that's additional profit back in your pocket.
Well, the $200, that's $2,400 of credit that we'll give a buyer at closing, and they only get it when they close. So you're absolutely right. If only 1 out of 3 closes, it's only going to cost us 1/3 of that projected expense. All right. Now, when I put those numbers into the Ultimate Profit Generator, it said, how much I can pay a seller, whether I give them no money down, $15,000 down, or $50,000 down. So on the offer with $15,000 down on a 9-year note, we can give the seller, the house can afford to pay the seller $800 a month, and then they have a balloon payment at the end of 9 years of $190,000. In fact, with this offer, Courtney, most people know that I developed this strategy offering principal-only payments and no interest. And if we paid no interest, we could actually pay $292. But if we gave them principal and interest, we could pay $274. Now, remember, the house is worth $250. It needs $10,000 worth of work. And in the Ultimate Profit Generator, there's a seller net sheet. And it actually is calculating that the seller would probably net around $200,000 if they, tried to sell it quickly. And,
right.
And that's after spending $10,000 because then they're going to pay holding costs and closing costs and buyer negotiation costs and all that. So the seller's net would normally be on this house $200, but we can offer them $274 with $15,000 down on the 9-year note, and give them interest. Now, the interest rate that I use is the lowest government interest rate possible, which right now on a 9-year note is 0.88%.
Pretty good deal.
Pretty good deal. And that overcomes the objection, where's my interest? And we also have tools in the Ultimate Profit Generator to show them, look, it's better for you to get a higher price and less interest than higher interest and a lower price because you'll pay more on taxes. Now on this deal, the Ultimate Profit Generator says that we need $44,000 to fund the deal. And why do we need $44,000? We need $10,000 extra to us in our pocket. We're going to be recapturing about $1,400 in marketing expenses, sending out postcards to get the deal. We're going to get our $10,000 that we need to fix up the house. We're going to get $9,000 for all of our buy and hold costs. So, and then the $15,000 to the seller. So all the money we need for the deal is raised when we buy it. So you have no money in the deal. So when you do these deals, you'll have no money tied up in the deal. In fact, you're pulling money out up front. Now, $44,000 on a $250,000 house, the loan to value on that first mortgage is 18% loan to value. All right? Wow. Mm-hmm. So that's a very well-secured loan that you can offer to your friends, your family, people you know. And people say they don't have private money, then I suggest you use our private money because I have raised private money for these free and clear deals. So we have done for you private money. Next would be our profit. Now, our profit target was a minimum of $50,000, and on this deal, it's calculating, telling us that we're going to make $71,000 over 9 years. We're going to get $10,000 up front. We're going to get another $6,000 down from our tenant buyer when it's occupied. We're going to get $5,000 in cash flow because on this deal, we're pretty much giving them most of the cash flow to pay down their note. And then we're going to get another $50,000 on the back end, and that's minus all of our costs and any credits to the buyer and all that. So we have a total profit of $71,000, which is a pretty nice profit these days for real estate investors that are struggling making money in real estate.
Right.
Now, our profit is locked in because if we sold, and this is a common question that we get that we kind of talked about on session number 1, is what happens if we didn't hold it for 9 years and we sold it early? Well, we always have the seller agree to either discount the note, we give them a discount schedule if we sold early, or move their note to another property for the full term. So we're always going to get at least our target profit of the $71,000. Now, what if the market goes down? Isn't that the question we had up front?
Yep.
Okay. Well, you can protect yourself up front if you expect that to happen, okay? So if you expect that to happen, you can use a lower resale price when you're doing your offer, when you're structuring your offers, okay? So remember, the house is worth $250,000. We planned on reselling it for $259,500. Well, instead of using $259,000 as our number, what if we put in $239,500, okay?
Okay.
Now, if we change that number, our offer automatically changes from $274,000 to $253,000. So we would offer the seller $253,000 on this same deal, okay? Still above market value on a house that needs work, okay? Now, even though we've structured our offers for a lower price, thinking that it might go down in the future, it is worth $250,000 today, and we are going to put it on the market for $259,000. And okay. And you might go ahead and sell it for $259,000, and you're just going to make an extra $20,000 if if they close at $259,000. Now, there's another thing you can do. Instead of changing the resale price, you can use more months of no appreciation. So currently, we normally say it's not going to appreciate for 48 months, and that includes the value of the house and the market rent. So we don't even expect the market rent to go up in 48 months. But I got to tell you, the demand for rentals are increasing, and they'll continue to increase. And the fact, for rents to stay the same for the next 4 years, I just don't think it's going to happen. I think we're going to see. I think we're going to see increased cash flow on these deals before we expect it, and that's just bonus profits.
Right.
Now, to protect yourself, you can change 48 to maybe 72. And so now we have, 6 years of no appreciation?
Right.
And that automatically changes our offer if we were going to sell it for the $259,500, it changes our offer from $274,000 to $257,000, just making that change. So as you can see, making these changes actually lowers your offer. You buy it better, provides you some of that protection that you're seeking. Now, what if you did both? Lowered the price to $239,500 and extended the months of no appreciation to 72, our offer would go down to $237,000. Now, $237,000 is still above what the seller might net selling it on their own, the $200,000.
Right.
So that's still a pretty attractive offer for someone who can sell it within 30 days, as opposed to fixing it up, putting it on the market, and hope they sell it, at sometime soon. Now, it does kind of drive our offer down below the after repaired value of the $250,000, and I don't like that. So what can we do? Well, one thing you can do is you can add both of these protections in there, and then change it from 9 years to 20 years. And if you offer them a 20-year note, your price is now back up to $281,000, still using both of those, concessions. And actually, because we have our annual profit project, that we put in there with a minimum, our profit on this deal is $158,000 if they accept a 20-year note with both of those concessions in there instead of $71,000. Now there's a couple reasons why to negotiate longer-term notes, and the way you negotiate that is you offer them more money to go longer term. But you do make more money, a higher profit per deal, and you have more time to perform. So if you're concerned about market ups and downs, if you have 15 or 20 years, it's less things to worry about, right?
Absolutely, sure.
Now, what if you already offered the $274,000, that's what we would normally do if we weren't concerned, and then later you actually found that the market did go down, and when you're ready to sell, you couldn't sell it for what you thought, and you should have offered $237,000 instead of the $274,000.
Okay.
Now that's going to be that's a $37,000 difference, okay, which that would eat into your profit. And if your profit's $71,000, then instead of making $71,000, you'll make $34,000. So in the worst case, you're probably going to walk away with $20,000, $30,000, $40,000.
Right.
That's if everything goes wrong. So that's kind of cool. So some tips on this is you can always negotiate with the seller if the market fell apart. Because if the market fell apart, it's going to be all over the news.
Right, exactly. If we have this happen again, everybody's going to know about it.
So if you find out that the only way you can sell the property within 9 years, so to pay off the seller, you have to sell it for less than you planned for, you can always go to the seller and say, hey, the market tanked. I can't get what I was projecting. Let's work together on this so I can close this deal with my buyer and get you paid off. I owe you $174 now. Would you take whatever, right?
Right.
Or I'll need more time or whatever. And now also if you have a little more teeth in that negotiations if you have a buyer who wants to close you out like 2 years from now. And let's say the market actually tanked over the next 2 years, and you had an opportunity to sell it at a discount or sell it in 2 years, but you couldn't get your projected resale price because the market went down. When you go to the seller at that point, if you say, look, I can sell the house now and pay you off, but I can't give you everything that you were expecting, but if you work with me, I can go ahead and get you paid off early. And if they say no, then you might not be able to sell the house, right? You might have to keep it for a longer period of time. And that's another thing. You don't have to sell these houses. In fact, I wish I owned all the houses I've bought still.
Amen. Yeah. Yep.
Why do you sell a house? You sell a house because you have some type of underlying obligation you got to take care of, like you got a balloon payment, or it's a bad property you want to clean up your portfolio. But in most cases, we sell houses so to raise some cash. And there's a number of ways you can pull cash out of a deal as you build equity up in a deal, or just go out and buy a new deal and raise cash that way. So the reason to sell a house is for example, I talk to investors, Courtney, who want to, instead of doing this terms deal, they just want to flip the house and make $10,000, right?
Right.
And I say, well, why would you do that when you can make $71,000 and still get the $10,000 you're after?
Exactly. Yep.
So the longer you hold properties, the more money you're going to make. That's really where the wealth is in real estate, is buying and holding. But you got to buy and hold right. And so that requires buying right. And that's what we do with our deal structuring and the ultimate profit generator, is it forces you to buy right. And you only offer what the house can afford to raise as far as money on a first mortgage using the equity in there, and the income, the net income after all of our expenses, is the most you would offer the seller on a note. So it's a very safe way to acquire and hold property. And if you want to reduce your management hassles and expenses, put buyers in the house with ownership mentality, and then and let them take care of the house and all that, and let them make it their own, and treat them as an owner, not a tenant. And my agreement with my tenant buyers is, you don't call me or you don't get your rent credit.
Right. Exactly.
All right. So you can always negotiate with the seller, unlike a bank, if the market tanked. Another way to protect yourself, like I mentioned, is to get longer terms on the deal. So if you're concerned about the real estate market that you're in, go for longer terms, 15, 20 years. And one of the reframes that I use with sellers, Courtney, is, yeah, I can actually pay you more than market value if you're in a position where you can consider, doing some seller financing. Now, we're not going to ask you to do a normal 30-year note. We're only going to ask you to go 15 years.
Right.
All right. Now, remember, you're worried about market going down. What if the market went up? What if the market went up faster and more and sooner than you expected? That's just bonus profits. So it's a double-edged sword. It can go against you and go for you. And I think again, when we're projecting no appreciation for 4 years, there's a lot of opportunities to go in our way. And the longer term you get on your note deals, the more time you have to perform, the more chances for it going your way.
Right.
Some final tips. We do have done for you private money. So if you want any information on that, you can get a hold of Dina. She's one of our program advisors. You can email her at dina@richgroup.com, or you can give her a call at 1-800-557-3171, and she's at extension 109. Also, another tip would be to use the Ultimate Profit Generator software. I don't see how you can structure these type of offers. There's so much number crunching to do this in a good way that you really can't do it without it. So if you don't have that, check into that. And if you do have it, give Dina a call and find out about the newest version, 3.0, which has a lot of new features to help you make better decisions and make it quicker and easier using that software. Also, it's also designed to help make better offers and increase your closing ratio. And finally, there is a new, in the version 3.0, there is a new tool. It's called the research tool. And use that research tool to check out the market trends and the market values and the market rent when you're putting the numbers together for a deal. So that's it for me today, Courtney. I wanted to knock that out, that question that we always get. What if the market moves against me? Now, is there any related questions that come up around that, or do we have any questions from the people in attendance that we can knock out before we go?
No questions from the attendees so far. No, I think that you covered it very well. I think the biggest thing for the most of the time the questions we get are people who obviously have just experienced the market downturn over the last few years, and their fear is moving forward and taking action and getting caught in a market like that. And I think you just showed that we have many things built into the ultimate profit generator that are very conservative in their estimates and protect you in many ways. Obviously, it would have been impossible to fully have been protected during this last downturn, but I mean, there's a lot of things built in, and you can make educated decisions to do the best you can do to make those moves forward.
Well, one of the questions I saw was that, what happened to the people a couple years ago, right, when the market moved against them? Well,
right.
I've been, we were putting out the red flags and the warnings in November of 2007 about, that was what we call the mortgage market meltdown in November of 2007. And in December of 2007, I decided to make this particular strategy of getting little or no interest rate financing from sellers as a way of protecting ourselves from the changes in the market. Instead of just using it as one of the things in the toolbox, I decided to use it as my main strategy. And I created the Ultimate Strategy Home Study Collection during December of 2007 and January, February of 2008. We created it through a series of webinars. Then since then, it's been our main focus. So a lot of people got hurt in 2008, when the market collapsed, and but we had already started doing this as our main model. So most people got hurt with different models. So anybody who's been doing this for a while, if they've had a market, and again, it's a local game, so maybe your market turned against you in the past couple years. I don't know where that would be, but if that was the case, well, hopefully you've gotten at least 9 years to perform. So you probably got a number of years left before you have to pay off a seller, and you have the chance, you have that time. So the best way to protect yourself is to have more time. I think you can use some of these strategies for lowering your offers and being more conservative. But what I find is people are too conservative a lot of times, and they lower their offers too much,
right.
And then they get not as many deals accepted.
Right. Then they're not getting the deals, and then they get frustrated by that.
Right. Okay, well, great. Well, we'll go ahead and do another webinar next week.
Excellent.
And we'll go ahead and take the next one on our list. We have a whole list here of ones to knock out, and maybe I can knock out a couple next time. In fact, I was looking at the list, Courtney, and there's about 3 or 4 of them that we actually covered on the last webinar, even though we didn't have 3 different questions. I have 3 different questions, asked in the same way.
So we can just say C number 1?
C number 1. All right. Well, anything else before we go, Courtney?
Nope, I think we're good.
All right. Well, thanks for joining me. Thank you, Dave, for recording this for everybody. We'll get a replay online for you guys, and we'll see you next week.
All right. Thanks, everyone.
All right.